Welcome back to the channel, and if you're new here, don't forget to subscribe and hit that notification bell because today we're talking about a stock that's been sitting in the bargain bin for a while now, and the question is, should you be buying it? We're diving into AT&T, ticker symbol T, a stock that trades between $15 and $20, making it accessible to almost every investor out there. But is this telecom giant a hidden gem or a value trap? Stick around because by the end of this video, you'll know exactly what AT&T brings to the table and whether it deserves a spot in your portfolio. Let's jump right in. AT&T is one of the biggest names in telecommunications, and when I say big, I mean massive. This company has been around for over 100 years and serves more than 70 million mobile customers across the United States. Think about that for a second. Every single month, 70 million people are paying AT&T for their cell phone service, internet, or both. That's a consistent recurring revenue stream that keeps flowing into the company regardless of what's happening in the economy. Now, what makes AT&T particularly interesting right now is that despite being such a dominant player in an essential industry, the stock is trading at a relatively low price. You can get into this stock with just $15 to $20 per share, which is incredibly affordable compared to many other blue chip stocks out there. Let's talk about why AT&T's stock price is where it is today, because understanding the past helps us predict the future. The company went through some major changes in recent years. They made huge acquisitions, buying DirecTV and then Time Warner for a whopping $85 billion, trying to become a media and entertainment powerhouse. That strategy didn't work out as planned, and they eventually spun off Warner Media, merging it with Discovery. These moves left AT&T with a significant amount of debt on their balance sheet, and that debt has been a major concern for investors. High debt levels can be risky, especially if interest rates rise or if the company's cash flow decreases. However, here's the important part. AT&T's management has made debt reduction their #1 priority. They've been selling off non-core assets, cutting costs, and focusing on their core telecommunications business, and they're making real progress in bringing that debt down to more manageable levels. Now let's talk about something that makes AT&T incredibly attractive to a specific type of investor, and that's the dividend. AT&T is a dividend powerhouse. So even after they cut their dividend when they spun off Warner Media, still offer a dividend yield that's significantly higher than what you'll get from most stocks. Talking about yields in the range of 5 to 7% depending on the stock price. Compare that to the average S&P 500 dividend yield of around 1.5 to 2%. And you can see why income investors are so interested in AT&T. If you invest $5,000 in AT&T stock with a 6% yield, you're looking at $300 in annual dividend income. It's money hitting your account every quarter without you having to do anything. For retirees or anyone looking to build passive income streams, this is extremely appealing. But a high dividend alone doesn't make a good investment. We need to look at whether AT&T can actually sustain that dividend and whether the business has growth potential. The telecommunications industry is essential, and that's a huge advantage. People aren't going to cancel their cell phone plans or internet service, even during economic downturns. These are considered must-have services in modern life, which gives AT&T's business a defensive quality. When recession fears pop up, defensive stocks like AT&T tend to hold up better than growth stocks because their revenue is more predictable. AT&T generates massive amounts of free cash flow year after year, and that cash flow is what pays for the dividend. As long as that cash flow remains strong, the dividend should be safe. Let's discuss what AT&T is doing to grow their business, because standing still in today's world means falling behind. The company has been investing heavily in 5G technology and fiber optic internet. 5G is not just about faster streaming on your phone. It's the foundation for future technologies like autonomous vehicles, smart cities, advanced medical devices, and the Internet of Things. AT&T is spending billions of dollars to build out their 5G network across the country, positioning themselves to benefit from this technological shift. On the fiber side, they're expanding their fiber footprint because fiber offers the fastest and most reliable internet connections available. As more people work from home and stream content, the demand for high-speed internet keeps growing, and AT&T is there to capture that demand. These investments require significant capital, but they're necessary to stay competitive and drive future revenue growth. Of course, AT&T faces competition, and we need to talk about that. Their main rivals are Verizon and T-Mobile. Verizon has traditionally been known for having the best network quality, While T-Mobile has been the aggressive price competitor, especially after merging with Sprint, AT&T sits in the middle, but has some key advantages. They have an extensive fiber network, strong relationships with business customers, and incredible brand recognition. The telecom industry also has high switching costs, meaning customers don't switch providers easily because it's a hassle to change phone numbers and plans. This customer stickiness works in AT&T's favor and helps protect their subscriber base from aggressive competition. From a valuation standpoint, AT&T looks interesting to value investors. The stock trades at a relatively low price-to-earnings ratio, meaning you're paying less for every dollar of earnings the company generates. Some see this as an opportunity to buy a quality company at a discount. The key question is whether this is a genuine value opportunity or a value trap, where the stock is cheap for a good reason. In AT&T's case, many of the issues that push the stock down, like the failed media strategy and high debt levels, are being addressed. The company is more focused now, sticking to what they know best, which is providing telecommunications services. If they continue executing on their debt reduction plan and their 5G and fiber investments pay off, there's potential for the stock price to move higher as investor confidence returns. Let's be real about the risks, because every investment has them. The telecom industry requires constant, massive capital investment to maintain and upgrade networks. This ongoing spending can limit how much money is available for dividends or debt reduction. There's also regulatory risk since the telecom industry is heavily regulated, and changes in regulations could impact profitability. Competition is always a threat. If T-Mobile or Verizon start winning customers with better deals or better service, that could hurt AT&T's growth. And finally, there's the debt. While it's decreasing, AT&T still carries significant debt, and if their cash flow were to decline for any reason, that could create problems. On the flip side, the upside potential is real. If AT&T successfully reduces debt to their target levels, we could see the stock get re-rated higher by investors. If their 5G and fiber investments drive subscriber growth and revenue increases, that flows directly to earnings and potentially the stock price. The dividend provides a cushion while you wait for any price appreciation, and if the company can even modestly grow that dividend over time, that makes the stock even more attractive to income investors. There's also the possibility that in a few years, once the debt is under control and the growth investments are paying off, AT&T could be seen as a stable utility-like stock, and those types of companies often trade at higher valuations than AT&T currently has. So who should consider investing in AT&T? If you're an income investor who wants steady dividends and can handle some risk, AT&T offers an attractive yield with a business that generates strong cash flow. If you're a value investor, looking for stocks trading below their intrinsic value, AT&T's low valuation could be appealing, especially if you believe in their turnaround story. If you're looking for a defensive stock that can weather economic storms because people need their phone and internet service no matter what, AT&T fits that bill. However, if you're a growth investor looking to double your money quickly, or you want the next Tesla or Nvidia, AT&T is probably not for you. This is a slow and steady type of investment, not a get-rich-quick play. Here's how many investors approach AT&T instead of putting a large amount in all at once. They use dollar-cost averaging, investing a fixed amount regularly over time. This smooths out the purchase price and reduces the risk of buying at a peak. With the dividends you receive, you can reinvest them to buy more shares, creating a compounding effect. Over 5 or 10 years, this strategy can build a substantial position while generating growing income. So what's the bottom line on AT&T? This is a large, mature company in an essential industry that offers income and value rather than explosive growth. Trading in the $15 to $20 range makes it accessible to everyone. The dividend is attractive, the business is defensive, and the company is addressing its challenges. There are risks, particularly around debt and capital requirements, but there's also potential for both steady income and modest price appreciation. Whether AT&T fits your portfolio depends on your goals, risk tolerance, and time horizon. Do your own research, look at the latest earnings reports, and make sure you understand what you're buying and why. If you found this analysis helpful, smash that like button. Subscribe for more stock breakdowns, and drop a comment below telling me what stock you want me to cover next. Are you buying AT&T or staying away? Let me know your thoughts. Thanks for watching, and I'll catch you in the next video. Happy investing.